Welcome back. Let's focus on PDS Limited in Q2. The company saw its revenue grow by 3%, but the net profit declined by 55% and EBITDA by 28% versus the last year. Sanjay Jain, Group CEO, PDS, joins us now to discuss the numbers and the outlook going forward. Mr. Jain, good morning. Thank you so much for joining in. Can you give us a sense of what the outlook is for FY26? What led to this profit decline this time around? And revenue growth came in at around 3.4%, which compares with Q1 revenue growth of 14%. Why was it lower on a YOY basis, and what's the outlook?
Hi, morning. I think these are very turbulent times, as you know, word over, given the tariff situation that has prevailed and also the retail sector in general in US and Europe being under pressure. Despite these challenging times, PDS, has tried to stay on top in terms of an 8% growth in terms of H1 over the same period last year. Yes, in Q2, we have a growth of about 3%. But what is important is that our order book today stands at about 5,300 crores, which is almost 15% up as compared to same period last year. So therefore, A, we've been trying to stay on top of the challenging times. B, entering the second half with a 15% growth in order book. In terms of profitability, I think there are two factors to it. One is for us, what is important is to stay engaged with the customer. If the customer has been facing pressures for the reasons I just mentioned, can I participate with them even if I have to pass some discounts to them, or even if I have to absorb part of the cost? That is on one hand. Secondly, we have invested close to 80 crores in terms of investment in new verticals, and they are under gestation phase. If I talk about the new verticals, while on one hand you experience a growth of about 4% overall, but the new vertical growth is about 46%. These are aimed at new geographies, new line of activities. So as two things, as the order book start unfolding into revenue, as we aim to cut the investment in new verticals by about 25% in H2, we believe the second half should be better than the first half of the year.
Sanjay, a couple of questions. Last time you gave a guidance, FY26 revenue growth to be in mid-teens. 8% done in first half. Does this FY26 guidance hold?
I think as I said, nobody had foreseen what happened to tariffs in the last 6 months, but what is important is the order book mid of the year is 15% up. So, we will keep a watch on how things unfold. We've been reading that India and US are likely to settle the tariff, interface very shortly. But what is important is walking in with a 15% growth. We'll keep a close watch as to how the H2 unfolds.
Okay, so you're unable to commit to that mid-teens revenue guidance as things currently stand right now, I guess. What about on margins? Because you are undertaking a lot of steps. There is cost optimization at the corporate level, the turnaround at New Lobster, even certain business verticals you're trying to restructure. What could be the exit margins that you're looking at the EBITDA level and PAT level, say this year and next year?
There are twofold measures that we started. A, on balance sheet, and B, on the P&L, things that you just asked. I think in the first 6 months, the balance sheet initiative has already started unfolding into results. We generated strong 590 crores of free cash flow operation in the first 6 months. Is because of the working capital squeeze that we started on one hand, and secondly, restraining on investment. So that I think is already unfolding to results. On the second bit, which is a P&L related initiatives, as I mentioned in response to previous question, we invested into growth. The growth investment is through P&L. It is about 80 crore hit in the P&L in the first half. We are aiming to bring it down by 25%. On one hand, that is an initiative. Secondly, we engage the services of BCG to try and help us improve our processes when it comes to procurement efficiencies, etc. We've come to near finality of their assessment. And as we start implementing this in the second half, we expect an improvement in the overall EBITDA margin as well as the profitability of the company. One should see at least minimum 1% improvement in the margins in the second half as compared to the previous half of the year.
Mr. Jain, you spoke of gestation periods. How long is this likely to last for your other businesses that are currently in gestation period? Once that gestation period ends, how does that improve your balance sheet? And since you, and almost a quarter of your top line comes from the US markets, right? So in the middle of all of these uncertainties, have you tried looking at other geographies to diversify that 25% and try getting it from other areas?
See, all things remaining same, typically it takes about 18 to 24 months in terms of any new investment to start giving a PBT break-even. But we know that last 1 year has seen disruption in Bangladesh and then the tariff issue. So therefore, it is taking on an average 1 year longer than we anticipated. But we believe we are on the path now to start gradually inching towards a break-even. We said 25 to 30% reduction this year and next year about 50%. So therefore, to precisely answer your point, whatever investments we have committed to at present, I think in about 18 months, we should expect them on an average to be PBT break-even. That is on number one. And I think on geography, we've actually had a lot of focus in the last 18 months on US market. And in fact, in the first half of the year, our growth to US markets have actually grown up about 25% as compared to the same half last year. If I just annualize what we did in the first half, we should do at least about 2,500 crore of sales to North America. So I think that's something as a heartening sign. In our kind of business, as we inch towards growth, all these investments actually go through P&L. That's why one observes. And one more point I want to mention that if I draw a trajectory of the last 5 years of PDS, the last 2 years have been into an investment phase, into new verticals, into new lobster. But prior to that, as in the first year 5, 4, 3, as we were harnessing what we invested, our PBT margin inched to about 3.5%. So therefore, in the next 18, 24 months, as we work towards monetizing, harnessing our investments, that's the kind of potential that is there in the PBT trajectory of the company.
So does that also mean that your capex, which is reportedly down 50% in the first half, does that see a recovery in the second half? And debt has gone down as well. So does that continue to trend down as well going into the second half of the year?
Yeah, it would be our serious endeavor that we continue to contain our debt in the second half of the year. We've already brought it down to levels you have seen. On the capex, last year we have seen significant investment into our PDS tower in UK and some of the other capex. This year, we clearly see a reduction in that. I think the next 12, 18 months, our focus is curtail investment. That's lesser of a focus. We are curtailing, but a bigger focus is we invested. Let's focus on harnessing what we're investing into.
All right, Mr. Jain, thank you so much for sparing time and joining us. Wish you good luck for the second half of the year as well. The management there of PDS expecting the second half of the year to be better than the first one. But here's a quick note for our viewers. If you would like to access expert-driven insights and actionable chart patterns, simply scan the QR code on your screen and subscribe to Money Control Super Pro and get daily expert calls, actionable charts and insights to power your investing decisions. Plus, the festive season, there is more reasons to celebrate. 10 lucky subscribers every day win 1 gram of gold. So don't wait, scan, subscribe and make your portfolio shine brighter with Money Control Super Pro. Take a short break, back on the other side.